Over the course of 2015, all the funds in the range produced modest positive absolute returns, so between sort of 0.5% and 2% roughly net of all fees over the 12-month period. Now clearly that's behind the inflation plus target, but actually it's ahead of inflation because inflation was quite meagre over the year. So not only have they generated absolute returns, all of the funds have generated real returns, so returns in excess of inflation. So it's not a great outcome for us, but it's not a bad one actually in terms of what the markets were doing. If we remind ourselves, the UK equity market, for example, was down over 2%, and even safe haven government bonds, the gilt market was only up 50 basis points, which is 0.5%. So our lowest performing fund outperformed the gilt market, and all of the funds outperform the gilt market and the equity market viewed together. So while it's not the best outcome in terms of our inflation plus target, I think it's actually not a bad outcome given what the equity and the gilt market did over that period. We got benefit from manager selection. We had some substantial outperformance from a number of our managers over the course of the year, which helped performance. That combined with the global allocation in the fund, it was a year where sterling was weak, the UK market was weak, so we benefited from having offshore components and translating those back into sterling over the period. And finally, in terms of negative detractors from performance, really our credit allocation was the biggest detractor from performance over the year. While we still think there's good valuation to be had in those markets, they were weighed upon by concerns on the credit cycle, where we are in terms of the economic cycle and what that means for debtors, and also the weakness of the oil price weighed on energy components of the high yield market as well. Well, from a purely valuation-driven perspective, there's a whole world of opportunities opening up to us today as markets fall up to 20% from their mid-year peak last year. We need to be cognizant of the macro environment as well. We can't just walk around buying cheap things because they can get cheaper. But in the main, we're seeing opportunities in the equity market still. There are pockets that are expensive, but there's still some pockets of great value there, and we need to be alive to those opportunities. So the fund positioning is always a function of our worldview and most importantly of where we see value in markets. So we're positioned broadly for a positive outcome in developed markets still. There's some concern around emerging markets, but we think actually at their heart, developed markets are still in reasonable shape and they will continue to grow with low single-digit growth for the foreseeable future. We've identified markets like the UK, US, Japan and Europe that are still reasonably attractive. We think the US is least attractive in that group, and so we favour the UK, Japan and Europe over the US. In the equity market, then in the fixed income markets, we remain lowly allocated to government bonds. We think they're expensive and we don't think they offer good risk and return trade-off for investors looking forwards. We do remain in the fixed income markets though. We use things like high yield, convertibles, even emerging market debt actually, in sensible position sizing to get a decent mix of returns drivers in the portfolio. Well, looking forwards, remember we're trying to beat inflation plus a margin, and the recent turmoil in markets actually gives us a good opportunity to find asset classes that will deliver us those kind of returns on a forward-looking basis. So what's next for us? We need to reassess, make sure that we're positioned in the right places, and if we're not, we start rotating out of positions we've held for a while into new opportunities in the funds. So stay alive to opportunities and do our best to smooth the path for clients on the way to achieving our outcome. That means we want to keep people invested. It means we want to do whatever we can to make the road less rough on the way to our outcome, because we focus on delivering the outcomes for our clients. And oftentimes, times like this where you have volatility, you find opportunities that are difficult to embrace, but you really must take advantage of.